Welcome everyone, back to the channel. Apologies for not bringing you updated content on logistics and the industry and the news, because ultimately we're not making money from this channel. We do have a real day job and we have to get out there to give business. During these uncertain times, we had to pound the pavement and do a lot of our stuff that pays the bills. So if you missed our content, apologies, but we are back now with a timely market update with what's going on with the industry from a pricing standpoint and what we can expect to see for the rest of this year. Since our last chat, a lot has happened geopolitically. The yo-yoing of leadership from Trump, from tariffs to war to bombing to ceasefires, we've had it all. One cannot be so wrong to suggest that this was a rather entertaining year if those decisions didn't really have any real world ramifications.
Donald Trump has posted a video on social media featuring a song called Bomb Iran.
But with that being said, there has been some response by the markets, and when I say the markets, the stock market and the mainstream market. But let's just focus on stock market for a while. They generally have sort of petered out relatively quickly. So for example, when the war started with Iran, the markets had a big shock. Well, not really actually. They had a shock for about maybe 24 to 48 hours, and then later on it pretty much petered out, and it's right now as we speak, it's nearing all-time highs, which tells you the general sentiment amongst the investors, and I dare say most retail investors, the mum and dads of the world, you know, the you and I's of the world and what have you. Whilst spending in general on consumables and what have you may be down because of the fear that's been drummed into us by all of these going-ons in geopolitical world, a lot of us out there still have a lot of money on the sidelines wanting to deploy to gain some level of income. A lot of the commentators are saying that basically from a stock standpoint, we are nearing the end of this super bullish pattern, let's call it that. Once it hits all-time highs, some of the conservative commentators are saying, well, we should expect a sharp downturn. Whether that's going to happen or not remains to be seen, but this will have a real world impact on the general spending patterns of the everyday folk. Whilst we're deploying all this money into stocks and not away from consumables, we're going to have an outcome that is negative from our day job standpoint, which is logistics, right? If people don't spend money, we have very little to move because the demand isn't there. And this is what we're currently seeing. Now, the market has been soft for the greater part of the last 12 months, purely because of all these uncertainties that's been going around.
Keep your eyes on the road, let go.
From an Australian economy standpoint, our inflation is generally within control, albeit the interest rates still are at all-time highs. Well, no, sorry, we have had one cut. Can it be cut more? Sure. But right now, I think our inflation is generally being kept under control. So we should expect more rate cuts to come if the general macroeconomics have a turn for the bad. Are people losing their jobs? Last check, not quite yet. While there could be some downsizing, there could be some reduced hours, by and large, people haven't been losing their jobs, especially in the Australian landscape or New Zealand landscape. Maybe New Zealand's probably had it harder than us because they are officially in a recession. Whilst on the financial world, we're facing this sort of uncertainty, you know, 1 minute it's high, 1 minute it's low. That has a real world repercussion on how we all behave on the common folk. Generally speaking, you've got the retail investors, which is your mum and dads, and you've got your institutional investors, which is the sovereign funds, the super funds, the insurance, whatever, right? Commentary has it that a lot of these institutional investors in the stocks and so forth are offloading their stocks at every turn, at every opportunity they can get. Whereas the retail investors are normally buying the dips, so to speak. So who do you follow? We don't know. But that sends us a pattern of these fluctuation, this volatility that we are seeing in the market. From a mainstream standpoint, whilst money from the retail investors are deployed into stocks more and more. It isn't being deployed in consumables. And let's face it, we've all bought enough. We've all have enough stuff in our garages, in our bedrooms and what have you. We don't really need to be spending more because we've just done it enough during the COVID years. From a percentage standpoint, in terms of the volume standpoint, over the last 12 months, the Australian economy, from a physical goods turnover type of standpoint, have probably, depending on which industry you are looking at, have suffered about 30 to 50% decline compared to COVID years. So that is a pretty significant downturn. And we have certainly felt it as a logistics company. Our volumes have dropped in unison with the general pattern that all industries are seeing in the declining of demand. Where are pricings going from here? Well, again, a lot of that will depend on geopolitics. A lot of that will depend on what Trump decides to do and what he decides not to do. But more specifically, it will depend on what the shipping lines will do. The ships are not going to be carrying full, or the airplanes are not going to be flying full. So how do you maintain floor on those prices? Well, quite simply, you take the supply out, right? And this is where I say, well, let the games begin from the shipping lines. So what we have already seen coming into July, pricing out of Asia will slowly creep up. And they're not creeping up because demand have all of a sudden had a resurgence. Now, I must say, as a side note, demand, generally speaking, from real demand, have seen a slight uptick compared to the first quarter, which is to be expected because we are coming into our shoulder season now, where volume traditionally ramps up. And we are seeing that. Not enough for prices to be going up. Why are they going up then? You say, well, if the ships are not coming in full or sailing away full, why are the rates going up? It's done because of the games that the shipping line play, and they come in the form of dry docking a vessel, or simply meaning that vessel that was meant to sail, they're going to dry dock it for repairs, maintenance, what have you, right? They might slow sail to just, all of a sudden delay the embarking or the debarkation of the cargo, right? All of that will slow the pace of things getting to market, which then will create an artificial bottleneck of sorts. Will there be genuine increase in demand as we head towards the fourth quarter of the year? Yeah, absolutely, because ultimately we're coming to Australian summer. Summertime is when we're a bit loose with our purse strings. We're out, sun's shining, we're happier, endorphins hitting our brain. We're doing shopping, we're just in holiday mode. So yes, of course, we're going to expect some demand increases, but definitely nowhere near the highs of the last 3 or 4 years. Not going to happen. And the shipping lines know that. But they will still want to get maximum margin or maximum revenue from each one of those spaces on their vessels. And the only way they do it, if there's no genuine demand, is by taking the supply out. This year will still be a lackluster year compared to previous years. Your overall freight spend for 2025, once we calculate all of the costs from January to December, should be much lower than that of 2024, significantly lower than of 2023, 2, and maybe even 1. 2025 will be the cheapest year for you to ship products into Australia or New Zealand in the last 5 years. If your shipping cost isn't the cheapest compared to the last 5 years, you need to come and speak to us, right? Because you're not paying the right rate. I'm the last person to say go for the cheapest because, with logistics, it's quite simple. You get what you paid for. Say, for example, for argument's sake, I'm going to pay $1,000 for that container space. You're not really paying for that container space because anybody can give you that container space for that rate. The actual rate you pay, really is about the access you have to qualified people. That's the real value in logistics services. So never start the conversation if you're searching for a new provider and say, hey, what's your best rate? No professional is going to bite on that request, right? Because what is best best is subjective. There's no objectivity to best at that stage of a conversation. You're paying for someone's time to help you manage your shipment, help you manage your livelihood from point A to point B. The ships will run and robot can do it, right? Any monkey can do it. But things always goes wrong at some point. And the money you pay for it to your logistics provider is to make sure when things do go wrong, it is managed correctly. So any disruption you may be experiencing is curtailed or shortened. That is the real value of a logistics company or a freight forwarding company. We are not measured by our container rate. Please don't do that, guys. We're a service industry. I know a lot of our brothers and sisters in the industry haven't been trained well enough to sell better. And because of that, all they do is they use pricing to sell. And unfortunately, this is where we have arrived as an industry. Making $50, $100, even $200 a container in the freight forwarding industry in Australia is not sustainable in the current level of labor costs, current level of all costs that you are experiencing personally and as a business. The ones that will say yes to those margins, you need to question what is their commercial and economic sense. Do they have any business acumen at all? Are they buying your business? Or are they simply just so desperate that they will just take anything? Is that the type of company you want to be with? What we move isn't containers. What we move are your livelihoods. And are you willing to put your livelihoods onto those operators who are willing to do it for next to nothing? With the general macro financial conditions that every country is going through, this uncertainty, this is probably the worst time you need to be going for the cheapest, because this is when the cowboys come out. And the last thing you want is to have a highly volatile supply chain that will impact your bottom dollar. Your saving doesn't come from a $50, $100 saving on a container rate. Your saving comes from avoiding disruptions that are brought by those $50 margin offers. And on that bombshell, thank you for watching. And if you have any questions and comments on this particular subject, please let us know. Reach out and I'll answer to you directly myself personally. Because when things are volatile, you shouldn't be going for bargain basement. You need to make sure why things are so volatile and can I afford to be dragged up and down with this volatility? Or should I be looking for consistency? I know which camp I belong to. Thank you very much.